Taking credit is one of the most difficult and challenging decisions that an entrepreneur needs to make. And today I'm chatting to Karl Westvig, who is the founder and CEO of Retail Capital, which is one of the fastest growing brands in this space. Fascinated to find out from him some of the tips and wisdom and tricks and techniques that are involved in actually doing this process successfully. Karl, so good to have you on the Heavy Chef Show for the first time. Welcome.
Thank you, Fred. Great to be here.
I want to kick off with the fact that I overheard your name in a sauna the other day, where all the best business discussions happen, the Virgin Active in the Silo collection of the waterfront. And somebody was saying about you that Karl is the best mind on credit in the country. So I'm going to start off with that statement. It's coming out the gates hot, but what would you say about that, Karl?
It's a big reputation to live up to. I guess, where it came from, so where my background's come from is, so I studied stats at varsity, so I did an honours in statistics.
Where did you say?
At UCT,
okay.
Did business science. I chose to get out of actuarial science. I started there and got out of it.
Okay.
And then arrived in 1994 at the Foschini group just as they were centralizing credit.
Okay.
So I had a stats background and they had data for the first time. And I was very fortunate to be put in a plane to San Francisco to build scorecards, learn about the new credit systems, implement them, fail at many cases. So we literally...
How old were you back then?
24.
Okay.
23, 24. And so I got a lot of rich experience very early on in my career. So right place, right time is the bottom line.
Gotcha.
And then we, at the Foschini group, we expanded the number of accounts massively. We did 1 million new accounts in 1995. And the next 2 years, we wrote off a third of them as bad debt.
Okay.
So it was easy to hand out money, but when you started seeing the bad debts and the fraud come through, we then had to go and fix it. And that's where you really learn. You don't learn about giving money away. You learn about collecting it afterwards if you've made a mistake.
So talk about a learning experience. A lot of people don't even, I think many people in the public domain don't realize that companies and groups like the Foschini Group and Truers and Lewis and all these guys are actually credit companies, right?
Absolutely.
And I suppose that's where you cut your teeth and in the belly of that whole organization. And so what was that like and where did that lead?
So, firstly, when I started my career, 80% of turnover in those retailers, Truers, Foschini, Edgar's, were credit-based. Okay, only 20% was cash. That's reversed subsequently through various cycles, but every single day you're putting credit out to people who've never had credit before. So the credit bureaus that we have in South Africa now were originally built by the retailers advancing credit to the lower end of the population.
Okay, so there's like an accountability mechanism that everybody could start using, TransUnion and
Exactly.
So on and so forth. Yeah.
Exactly.
Okay.
And it's a big statistical game. So how much do you give? How do they use it? Who pays? Who doesn't pay? What limits do you give? What deposits do you ask for? So there's a lot of science that goes into those things.
Okay. And that gave rise to RCS, right? Through that whole...
Eventually. So RCS was built on the back of the Foschini credit history. So we approached Foschini in 1999 to say we've built lending business, in those days direct access. We took a management team to Foschini and said, you've got a balance sheet, you've got a brand, you've got customers, and we have expertise, let's build this business for you, which is what we did.
I'm just trying to follow the arc of your career. Then that obviously exploded and it became, RCS grew rapidly into the market, and obviously on the back of existing brands and with an incredible reach into the community. And you then went on to start direct access, is that correct?
So direct was prior to RCS.
Okay.
So we started direct access. There's a guy called Peter George who brought the idea back from the UK.
Okay.
We were backed in those days by Capricorn, which is the Enthoven funds.
Okay, gotcha.
And so 97 to 99 we built that.
Okay.
We weren't equity shareholders. as the management team.
Okay.
And at that point, we realized we'd spent 3 years building someone else's business for them without participating.
Gotcha.
And that's when we said, let's do it for ourselves.
Okay.
And then went off to Foschini and said, let's build something for you.
So it's amazing how interwoven everything is. Like all of these companies and all of these brands all seem to kind of, it's one hand washes the other to an extent, right?
Sure.
And so that, I mean, you clearly went through a process of really understanding credit. And I want to get to the real point of this interview is talking about business, I suppose. You've now taken the leap from extending credit to individuals to your, I mean, this amazingly fast growing brand, which is Retail Capital. And I have a bunch of questions around that. But first, I want to say welcome to Heavy Chef, because obviously now we're going to be partnering. And so full disclosure, we'll talk more about that in due course. What was that like in terms of the leap from the individual to the business, in terms of you and your understanding of credit?
Okay, so I mean, it's a multi-layered question. So firstly, I'll just go back to my personal side. So we were minority shareholders in a very large business.
Sure.
The only exit you have as a minority shareholder is to the big partner when they decide they're prepared to buy you out. So at the time the Standard Bank bought in, we had a right to participate in that transaction, and that's when I sold my shares and exited. That was around 2008. And it was just when the credit crisis was hitting, but already the writing was on the wall in South Africa with consumers being overlent to. Now, we were very conservative in our lending criteria, but you had all the other retailers and banks all climbing into the unsecured personal loans sector, giving much bigger limits than we were, and you could just see that there was this build-up of credit in the background. And at that point, you sort of got to take a step back and go, do I want to keep perpetuating that or not? And so I exited the RCS business at that point, and then we looked at the business lending space, which was underserviced and still is. So 12 years later, still underserviced, where we sit right now, where the average SME business owner can't get access to funding. And the banks over the years have become more conservative, not less conservative.
Sure.
So there's this dearth of credit or access to funding for that sector.
Is that as a direct result of there was the crisis in 2008, but there was also this lending spike where a lot of people and some brands like African Bank and so on were getting into uncharted territory where things were a little bit too overexposed, right?
So that was in the consumer sector.
Yeah,
so
I'm saying
exactly
was
right.
there a sort of temperature that suddenly started to go up that everybody became very concerned?
I mean, you had the failure of Sambo, you had the failure of African Bank,
Yes.
which was split into two banks, into two businesses. So there were a number of Unifer prior to that. So there was a number of consumer finance failures leading up to that.
Okay.
And once again, through the crisis, the guys that were well managed, that had good capital, good access to funding, survived and are thriving today. Capitec's a great example of business that's thriving today, and so is RCS. But then the step out of...
There's a thread, I just want to pin on that, the thread of liquidity, which we'll get back to a little bit later, right? Those are the guys that really survived and then thrived very quickly.
Absolutely. When the market, effectively, you take the supply away, someone has to fill its supply.
Sure.
And that's what they did.
Okay.
So it's been good for them.
So there's this dearth, right? And this is where Retail Capital is stepping in and clearly growing quite rapidly, right?
So the genesis of it, so banks typically are asset-based lenders. So you need to have some security, either a house or a car or something which they'll lend against. The average retailer doesn't have assets. A restaurant has some tables and chairs and that's it, and they have a lease, a
high rental,
exactly.
Usually.
So there's no collateral to provide, so they can't get access to funding. So we found a model in the US called a merchant cash advance, which essentially we lend against their future credit card transactions. And that's what we lend against. That's our security going forward. And which means 8 out of 10 restaurant owners we can fund off the back of that.
Which you can do because of the access to data, right? So you can start to track the data results, and over time the pattern and the trajectory start to present a very clear picture of what the business's health looks like.
Exactly right.
Okay, so merchant cash advance, and that was really the kind of the initial product that started to grow retail capital, right?
Yep. So that we started 2011, so 9 years ago. We're coming up to our 10th year.
Wow.
And as they say,
It feels like retail capital has only been around for the last couple of years, right? But it's really been, I suppose, germinating in the background and now really growing.
So it had 4 years of sort of steady growth, understanding the model, but it was a single distribution channel and a single product structure. And the last 4 years, we built multiple channels, take on multiple partnerships to scale, and spend a lot more on the brand.
Okay, I want to quickly touch upon the partnerships thing. Obviously, we've become partners, so I'm super excited about that. But before us, I mean, I think from the outside looking in, it looks like there's been a real symbiosis with Yoco, right? And the combination of your merchant cash advance and then the Yoco vendor database. How did that formulate? Was that like a shower idea, or how did that kind of emerge into the marketplace?
So at the core of it, the biggest cost in many of these businesses is distribution, it's accessing customers. So where we do a 500,000 Rand deal, we can afford to send someone to sit in front of the business owner, have a long discussion, take 2 months to decide, and then do the advance. When you start dealing with micro merchants that are doing 20, 30, 40,000 Rand turnovers, much smaller facilities, you physically can't send people and acquire the customer. So then we started saying, let's find some people who've got data where we can pre-qualify them based on their performance and then make it available through a digital channel, either through a mobile app or through a web portal. And that's when we had a discussion with the likes of Yoco and said, you've got data, we've got capital in the balance sheet, why don't we make this available to all your customers?
And I guess we've had many conversations on the show and within the Heavy Chef context around partnerships and the importance of partnerships. And that's just a great example of where a partnership really benefits both parties and you both grow at the same time, right? Yeah. Then segueing into the actual credit that you receive, right? So as a business, I'm going to ask you a pretty straightforward question. I mean, we service a community, a very fast growing community of businesses within South Africa and Africa. Karl, okay, this is a basic question, but I'm going to come out and say it and ask it. When should a business actually ask for money? When should you bring credit into the business?
So, in simple terms, avoid consumption-based lending. So, don't go and take credit if you're going to get in a plane and fly overseas and you're going to need to show for it. Okay, as an example, that's more in a consumer context. In the business context, we look at two things. Either there's an opportunity, which means your business makes more than the cost of the credit, or there's an opportunity cost where you can't afford not to have funding. Okay, so if an opportunity space. So if you're going to pay 10% for access to funding, you know that you can buy stock, you've got a 30% gross margin, you can turn the stock over 3 times, you can make 100% return, and you're paying 10% for the money. It's a great idea. Access the funding, leverage it. If it's going to cost you 30% and you only make a 10% return, it's a bad idea. Don't use it. You're just going to get yourself deeper in a hole. So that's on the opportunity space. On the opportunity cost side, what we see is businesses have challenges all the time. So if you're a big retailer and your fridges break and you can't keep your stock cold, that's a challenge.
Yeah.
If it all spoils, there's a much bigger cost. So then you look at the cost of credit or cost of funding relative to the opportunity cost of not having the funding.
For sure, the business closing down, right?
Yeah.
So,
but certainly what we found with business owners we work with, they're commercially savvy. So when you say to them, that's the cost of funding, they then look at either opportunity or the cost and go, it makes commercial sense, we'll take it. And hence, we actually see a very low failure rate in our business.
Okay, which is amazing. And I mean, I think you're starting to look at these symbiotic relationships between the credit lenders and the businesses themselves. I mean, some obvious examples internationally, like Grameen Bank and so on, where the founder won a Nobel Prize, right? And who would have thought that a money lender would win a Nobel Prize? And
sure.
and you're starting to see that there's a real shift in the thinking of the lender being this bank that's just writing out checks and kind of holding you around the neck.
Yeah.
There's a there's a win for you if the businesses that you serve are really succeeding, right?
I mean, in our case, so we collect out of the future cash flow of the business. If the business stops trading, we don't get our money. So we
for your businesses to realize that you are, in a sense, an investor in their business. It's a complete paradigm shift for them, right?
Yeah. We don't want business to fail. Sure. We want business to thrive, because then we collect money faster and everyone does well.
Sure. And the risk is mitigated. I want to quickly touch upon risk, and we have a big elephant in the room, and we're now starting to see coronavirus come into the country for the first time, and everybody's buying lots of toilet paper. I want to know from you, I mean, there's no precedent for that. I mean, there's maybe one or two incidences, in our recent past, but for something as contagious as this, that's spreading as quickly and it has this kind of level of paranoia, maybe SARS was an example, but the reality is this, how much of a risk is that for businesses? And I mean, it's a bit of an obvious question, but I want to just get into that. And how can you mitigate against the risks?
I mean, what we're dealing with to a large extent is what they call a black swan event. It's a sort of, you can't predict these types of things. So certainly what we look at in our business, and it's advice for other businesses too, is shore up your cash. So if you plan to go and take a whole lot of cash and go and buy a house for yourself, resist it, hold back. So the business that survived through, let's say, the 2008 credit crisis were ones that had strong balance sheets. They had cash in the bank, they had cash flow they could manage. I mean, you can't prevent it happening, you can't prevent corona, you can't prevent it coming into the city. But if it does hit and for a month you have to close your doors and you want to trade when it opens again, you need to be able to fund people's salaries, you need to be able to fund some suppliers, you need to be able to still fund your utilities. If you don't have that cash, you close your doors. That's the end of the game. So my advice, as soon as you have turmoil or uncertainty, is batten down the hatches, shore up the cash, access liquidity if you need to. I mean, we certainly will increase our liquidity facilities to make sure we're around going forward. But yeah, you need to make sure you keep your costs down and have cash in the bank.
For sure.
To survive it.
Yeah, and I mean, on the note of Black Swan, I think, Nassim Taleb talks about the opportunity within the Black Swan events. If you are cash flow positive, and there is then, business strategic advantage to having liquidity. Yeah. Lastly, on the topic of business and the people running these businesses that you serve, I want to just ask this question of a lot of people, and it's just always interesting to get the perspective. How would you define the role of CEO?
So if I look at my context, and I'm fortunate that we have a lot of very experienced executives I've worked with for a long time. So my role typically has been more about facilitation, and it's about getting the best out of each individual person. And it sounds a bit cliche, but you've got to free people. You've got to free them of what's around them and allow them to think, create certainty in an environment. Every business operates with an uncertain outcome. You don't know what the interest rates are going to be, or whether SARS comes or doesn't come, or coronavirus. So how do you package it up and create certainty for the people in your business? So to some extent, you're looking forward, you're trying to anticipate what might happen, and then you're putting certainty back into the business. So my role is not going to go, hey, there's coronavirus, we've got a problem. Sure. Rather, in case we have coronavirus, these are the 3 actions we're going to take.
Gotcha.
What role are you going to play in each of those?
Gotcha.
So you're almost playing the interpretation role between the external environment and the internal environment.
Yeah.
To some extent. In high growth phases, it's actually easy to manage a business because it's just about managing resources. In a low growth or a crisis time, that's when real leadership stands up. And I lived through 2008 with RCS.
Yeah, I can imagine. That must have been quite a hair-raising time.
And it's easy when business is growing 30% every year, but when it's going backwards 30% every year, and you've got morale issues, and you've got people who want to leave, and you've got Yeah, that's when true leadership stands up.
Yeah, that's when a character is revealed, right?
Exactly right.
As opposed to grown. I love that answer. That's really, really great. And actually, I was chatting to the leadership guys at Xero, it's also a partner of ours, and they were talking about their CEO worked with Steve Jobs, and Steve Jobs is famous for saying, look, just be free to do what you're supposed to be doing. Do not get distracted by too many things. Everything is secure. You just need to do what you have within your remit. And there's such a liberating aspect to that, as opposed to being, I think, that clarity that true leadership brings. I commend you on the clarity that Retail Capital has and the growth that you've achieved, and
Thank
long
you.
may it continue.
Thank you, Fred.
Cool.
It's been great.
There we go. We're not going to.
There we go.
There we go.